Hi, good morning, and welcome to the webinar preparing to sell a business during the pandemic. The webinar is running from 11 o'clock until 12:30. It is being recorded as well, so you should be able to catch up on this afterwards. I think we're just waiting for a couple more people to join, and we will be presenting fully very soon. Just in terms of who we are, I'm Steve Plaskett. I'm Head of Corporate Finance at MHA Tait Walker. So I'll be saying a few words at the very start and at the end. And we've got a couple of other presenters which I'll introduce you to later on as well. And we also want this to be interactive, so there will be a Q&A session at the end. If you look on your toolbar on the right hand side, there's a couple of question marks which are the show Q&A icons. So if you click on that, then you can type some questions in there, and we'll endeavour to answer those at the end. So we should have about 20-25 minutes of a presentation, and then we will have 5-10 minutes for the questions at the end. In terms of the agenda for today, we'll be looking at the M&A market update and market trends and expectations, and that'll be with Lee Humble. So Lee's corporate finance partner joined the firm a year ago, and he's had lots of experience in corporate finance and in working in the finance and banking community as well. Tax landscape will be covered by Adrienne Peterson. Adrienne is someone who's very experienced in terms of transaction tax, and I've worked with her off and on for something like 25 years now. I'm sure she won't mind me saying that. And then I'll come along at the very end and explain something around planning for a disposal process. So without further ado, I'll let Lee present now.
Thank you, Steve. So the first slide, please, Sam. From a mergers and acquisitions perspective, 2020 has clearly been quite a strange year. The back end of 2019 was largely suppressed due to the uncertainty posed by Brexit and the UK general election, with the result being Q1 of this year started quite quickly. Post-COVID-19, however, we've seen a natural contraction in confidence and therefore activity, with April and May showing a 50% fall in deal numbers. The summer has seen some improvement, with August showing activity levels only 20% down on last year, and September tracking just 10% down. Some obvious observations would be that sector variances have become exaggerated, with the likes of retail and leisure significantly down and increasing levels of activity becoming insolvency-led, whilst technology, pharma and some health sector-based businesses have continued to track strongly. Similarly, it is noteworthy to watch average deal sizes, with recent activity involving an increasing proportion of larger businesses. A factor behind this is the liquidity contraction which is taking place at the small end of the market, despite the availability of debt through government-supported lending. From a valuation viewpoint, there is increasing pressure and focus in the market, with discounts of up to 25% being applied and higher percentages of deal values being pushed onto deferred and target-based profiles. This will have inevitable tax consequences, and obviously with a capital gains tax review underway, professional guidance is going to be key. Private equity investors obviously were quite quiet kind of post-lockdown, but they're now back in the market with some vigour, and I do think that they will occupy an increasing percentage of deal flow in the coming months. And generally, I think for those who are considering a process, planning is key. Due diligence is going to increase, so it's going to be essential that you get your ducks in a row, insulate those COVID months and keep your financials up to date. Next slide, please. So with regards to what comes next, I think there'll be more of the same in the short term, with activity confined to certain sectors and private equity involvement in deal flow potentially going to increase. Whilst there is a shortage of strong assets in the context of private equity, the need for private equity to deploy remains, and hence I think we'll see a bit more buy and build strategies featuring, and perhaps a lowering of the bar in terms of check sizes to support such acquisitive behaviour. From a valuation perspective, there will be inevitable pressure, with several accounting periods likely to be impacted by COVID and underlying profitability expected to be less than what it was in 2019. The valuation debate, however, is only one aspect to watch out for, with overall deal structure perhaps more important. Again, that's because we'll see more deferred consideration and a more increased amounts of payment linked to targets. That shift in the risk-reward balance will have implications for those transacting, both tax-based and otherwise, so you're going to need some advice. From a liquidity perspective, obviously debt is becoming difficult to obtain. Obviously, we've seen the CBILS application window has been extended until the start of next year, albeit other conventional debt is still hard to come by. Again, this will mean that a lot of transactions will become different in form, so either private equity supported or cashless by nature. What that means is I think we'll see a bit more mergers, and where there's MBOs, I think we'll see a lot more vendor finance deals because it'll be the only route for business owners to dispose. With that continued shortage of finance in the small cap world and hunger from private equity, I think average deal size could increase. Obviously, the anchor to that will be any insolvency-led trade and asset deals, which will become an inevitable ballast. So in short, I think the M&A market will remain extremely fluid, albeit some confidence should be taken from the high number of cash buyers, the private equity presence, and let's not forget that there's a lot of overseas buyers in the market right now. I think both Brexit and favourable exchange rates will keep them there for quite some time. So yeah, that's it for me. So on that note, we'll push over to Adrienne to talk about the tax aspects.
Good morning, everybody. So I'm going to take you through the tax landscape. If we can move on to the next slide, please, Sam. OK, so something that dominated September and October was the budget. We were all entirely expecting a budget in November, but obviously with COVID it was called off. It's delayed until spring of next year, which is likely to be February, March. That's usually when you get the budgets. But what were the rumours that were going round? And it's likely that some of these will be implemented. As Lee mentioned, that there is a consultation on capital gains tax. It's currently running to this month. And the view is that capital gains tax rates are highly likely to increase, perhaps go up to 25 or 30%. And so that obviously will affect the net tax outcome from any deals that are done. Corporation tax increases are possible because for many voters this is seen as the least worst outcome because it doesn't affect them, but many individuals. Capital allowances, something to be aware of is that currently if you have capital expenditure that qualifies for allowances, you've got £1 million threshold each year which you can get full relief for. That's dropping to £200,000 from January of next year. National insurance and for the self-employed and IR35. IR35 being the view that the revenue take in respect of individuals who they feel appear to be self-employed, but actually the revenue deem them to be employed. And national insurance for self-employed individuals has always been lower than for the employed, and so it's likely or possible that there will be balancing out of the national insurance contributions between the employed and the self-employed. Pension contributions, these are always a political hot potato and have been tinkered with quite a lot. So changes in the pension contributions, tax relief, it's a possible change, but probably not one of the front runners for a likely change. Next slide, please, Sam. OK, so what if you are thinking about doing a transaction and we definitely know what we don't, I say definitely, we don't definitely know, but it's likely that capital gains tax rates will change. We had earlier this year the entrepreneurs relief, the reduction in the limit for entrepreneurs relief. It's previously you could get up to £10 million of gain, taxable at 10%. That came down to £1 million. Anything above your £1 million gain is now currently taxable at 20%. But in the future, if rates of capital gains tax go up, that's likely to it will change as well for any gain you have on a sale of your shares above the £1 million threshold. So what is the impact of these potential changes? The first three columns there are what would be your outcome if you have £1 million of proceeds and you pay capital gains tax at 10, 20 or 30%. And obviously, as you would expect to see, as the capital gains tax goes up, your net proceeds go down. If you decide, if you can get a deal through before any change in the rates applies, then great, you'd be able to lock into the lower rates. However, if you can't get a deal through, or you're not yet contemplating one, what would be the effect if you hang on and you wait the higher rates? How much would you have to increase your proceeds by in order to stay at the same effective rate as if they hadn't increased? And you can see there that at 20% rate of capital gains tax, your proceeds have to go up by 12.5%, and at 30% rate, your proceeds have got to go up by 28.6%. So you have to grow the value of your business more than the rate of increase in the capital gains tax rate just to stay level. Next slide, please. So if we're in a pre-sale position, what are some of the key things that you might want to be considering now? Well, are there any non-core assets, or is there an element of your business that you wouldn't want to sell or be sold with the company? If so, you need to take action well in advance of a sale. Do your planning early if you want to take advantage of any tax reliefs that are available to get those assets out or to get that business moved out. What about motivating key staff? If these are going to be crucial to driving the value of your business, are you considering implementing a share scheme to reward individuals? The message there is you must implement early and well in advance of a sale. Profit extraction. Do you need to be considering the scope for pension contributions? Should you be reviewing your dividend strategies? All things to take into account in the run-up, not just immediately before a sale, but in the years and months in running up to a sale. And finally, share structure and ownership. This is a plea to make sure that your house is in order in terms of your share ownership, in terms of your books and records being written up to date. It causes unbelievable complications from both the tax and legal perspective if the house is not in order and your articles and your share certificates are all not correctly up to date and as you think they should be. So review those well in advance of any sale. Next slide. So what if you're actually going through a sale process or very close to one? What is the form of consideration? As Lee mentioned, it's likely that we're going to see more deferred or more earn-out forms of consideration. Definitely, if something is deferred or is an earn-out, its tax treatment is different to straightforward cash consideration. So you need to take tax advice early so that you're aware of what your net cash or your net tax cash will be from the deal. HMRC clearance, many transactions need an advance clearance from HMRC, and what we can say at the minute is that the Revenue are taking their current approach is changing to clearances. They're certainly scrutinising clearances in more detail than they previously did. We haven't necessarily had any rejected, but we've had questions raised where you wouldn't have expected that before. So perhaps your clearance might take slightly longer. Plan that into your time scale. What about ideas to trigger capital gains tax? Can you trigger a gain before an actual sale takes place in order to benefit from the lower rates of tax, capital gains tax? Message there would be to just be careful over that. There is significant amounts of anti-avoidance legislation being introduced in recent years to stop people triggering a CGT gain unless they are actually selling and relinquishing control of their business. What about a sale to an EOT, an employee ownership trust? Something that has been around for a number of years, and a sale to an employee ownership trust is capital gains tax free if you are selling a controlling shareholding. It's not for everybody, but as rates of capital gains tax go up, this might be something that we see coming into the landscape a bit more often. As I say, it's not for everybody, but it's certainly for certain businesses something to consider. And lastly, if you've already completed on a transaction and you took a form of consideration where you can elect or choose when it's taxed, i.e. at the time of the deal or at a later point when you're paid out, for example, a loan note would be the typical one, there are time limits for making the election, and you might want to review the previous strategy that you took in light of the fact that capital gains tax, or if capital gains tax go up, capital gains tax rates go up. Next slide, please. Okay, looking at future taxes and future reliefs, what have we still got available as well as entrepreneurs relief? Don't forget EIS relief and investors relief. Investors relief is, in terms of the amount of the relief, it's £10 million at a tax rate of 10%. So very similar to the old entrepreneurs relief. One of the key conditions here is that you can't be an employee or director of the business, but it's something that's not, don't forget it's still there, available to unconnected investors. An EIS relief, if you've made an EIS investment or you plan on making one, then the gain from EIS, sale of EIS shares, is again tax-free, and not forgetting that when you make your investment, you've got income tax relief available. Next slide, please. So I mentioned earlier about perhaps you might be looking to introduce a share scheme for your employees. Well, now is quite a good time to consider putting one in. Just in respect of valuations, we generally, to get the best net tax position for an employee, you're looking for a low valuation to be agreed for tax purposes. This is a tax valuation, not a commercial valuation. You're looking to agree a low valuation with HMRC, and certainly in the current circumstances, HMRC are amenable to low multiples, to agreeing an additional discount for the uncertainty created in the marketplace due to coronavirus. You may have additional debt within the company that's driving down the valuation. So in terms of getting low valuations at the minute, to make it to give your employees the best net tax outcome, now is a good time to be looking at schemes. And EMI schemes are great schemes. They're HMRC approved, so they can effectively be a no risk scheme for the employee, and exit only for the employer. So that is one to consider, but there are other share schemes available. It is something you'd need to take professional advice on. And with that, I'm going to hand over to Steve.
Thanks, Adrian. That's fantastic. That's really helpful. What I'm going to talk about on the next slide is some of the actions that you should be taking if you were thinking of planning for a sale, especially for those who are planning a sale before the day of the next spring budget, which is when the tax changes and the increases in capital gains tax may happen. I'll talk through a bit later on the valuation and potential buyers. On here, I just really want you to touch upon some of the actions that you should take to increase your business valuation, and also how you should make yourself more attractive as a business. First of all, improving the business model and building your operational plan with a sale in mind is the starting point. And often for that, you might need to explore disposal strategies and advice to understand whether a trade sale is better, or whether an EOT or a management buyout might be suitable. Having great management information and great data is so important nowadays, and also having a really incentivized management team. If you have both of those, then you're going to be in a position where you can evidence the right amount of information, which is going to be attractive to buyers, and help to drive the business valuation up. And finally, on here, become known to your potential buyers. You need to give some thought to who those buyers would be. Most of the deals that we're seeing at the moment, and most of the deals that we're seeing that are happening relatively quickly, require you to be known. So you need to raise your profile, you need to be in the trade press as well so that people can identify who you are. On the next slide, this is just an indication of the variety of valuations that we do see. Now, we have an example on here which is for consumer brands, and we've plotted some data on the various multiples for deals. That's a multiple of the price compared to the earnings, and we've plotted that against the enterprise value. Ranging from sort of £100,000 to 10 billion. But broadly, you can see a lot of the dots around here are around the 10 million deal size and around the 5 to 10 to 15 multiple as a valuation. The whole point of this is to say that there's no simple valuation. We often get asked this question, but it's going to be different for each sector, and even within a sector, it's different for each company. Probably looking at for around about a £10 million deal in this example, an average of 8, but you can see there's some big outliers there. Some really positive, 15 or 20 multiples, and they're probably the ones who have got recurring revenues, who have got their own intellectual property, and evidence of growth, and a really strong business plan and management team that can deliver that growth, which the buyers will see as well. On the next slide, looking at the buyers, we've put on here some various types of strategic buyers. Now, these are all types of company that we have sold to this year. These are all buyers who can help solve each other's constraints, so they can solve your problem as a developing company, but you can also help solve some of their problems as well, and in that way you're generating synergies and you're generating even greater values. Obviously there will be companies that you know already that will be looking to buy you. If you're looking at trying to get a deal away within the next 6-8 months, then private equity and acquisitive companies are those who can complete deals early, and we know that private equity have the funds to get those deals done, and are used to smooth and quick acquisition processes, as will be the acquisitive companies. Overseas groups, yes, we've seen sales to those, to a couple of those this year. We've sold HTL and Orchard, who I'll talk about later, to US groups. And just a word on competitors. Obviously, you'll need to have a non-disclosure agreement in place before you release information, but also if you're releasing information to competitors, then you do have to be really careful about what you release and when, and sometimes you have to redact a lot of information before you know that the competitors are definitely keen and able to acquire you before you release some further points towards the end of the deal. In terms of how we find these buyers and sources of the buyers, then we have invested in a number of subscription-based research capabilities to try and find the buyers. That's also useful for us to try and find the valuations that are really relevant to your sector. And we're also part, as many of you may know, of a UK network called MHA, and that allows us to be part of an international network called Baker Tilly International, and that has proved a really good source for finding potential buyers in the past, and will do in the future as well. It's not just our knowledge though of buyers or contacts. It's also companies that you will know, that will be that you may have met before at trade events, or that you may have seen as competitors. They're also a good source of buyers, and accessing and finding others through LinkedIn or through our other networks and contacts is normally a strong way of finding them. The deal that we completed this week was the sale of Black & Banton to Marlowe's PLC, and that's one where we found the buyer and introduced them only about 7 months ago. So the deal happened relatively quickly from that point of view. On the final slide up on here, it's Again, a summary of the sale of Orchard Information Systems, which we sold to a US company called MRI Software on March the 13th this year. So we sold it the day before lockdown, or the lockdown 1 was announced. So that was a very good time to get that deal away. And it does show that deals do happen during the pandemic, and also at very strong multiples. As a bit of background, Orchard had been going for 40 plus years. I helped them about 20 years ago to raise some funding, and was reintroduced to them this time last year because they'd had some interest from a couple of potential buyers from the States. They'd been speaking to them maybe for 18 months, and they had been getting ready for sale. 2 years before that, they'd recruited a new MD with growth and sale in mind. So October last year, when we were reintroduced to them, we started to prepare information. We went to visit them in Cleveland, Ohio, and presented to them in December. We took time to identify potential synergies with them. And also we implemented a new management incentive scheme and shared a lot of information with them as well in that period between start of December and end of February, when they made an offer. And within 3 weeks we completed the deal. So that deal completed on the 13th of March. It was a very driven sale process. It was a company that knew the sellers. And it was a competitor as well. So we had to make sure that everything was tightly controlled. But because there was a very strong management team, because they were incentivized, and because they had a lot of data, then it worked really well as a deal. And I think it was the largest deal that completed in the Northeast this year. So it shows you that if you are well prepared and you know the buyer, you can achieve a deal before the spring budget. So thank you very much for listening to the presentations. I'll ask Lee and Adrienne to unmute themselves as well now. We do have a couple of questions that came through before the webinar, and one was around the impact on valuations as a result of COVID, which is probably one for you to answer, Lee.
Yeah, so I think it's a very good question. I think the evidence so far suggests that discounts will be quite broad, in that they'll be up to 25%. Now, clearly that will be sector-led and driven by the quality of earnings in the business in question. So the quality kind of reference comes to just how stable the earnings are, how stable your client base is, and just the risk attached to your business. I think the more likely route for buyers is probably going to be to use earn-out structures, whereby that will be the means to bridge any valuation gap. An earn-out is obviously just a structure whereby future payment is linked to the satisfaction of a certain performance hurdle. It is an area to be careful with, because with complexity can lead to the ability to fall out further down the line. So you've got to be careful with that. But yeah, valuations are being impacted. It just depends on the business in question.
No, that's great. Thank you, Lee. And the other question was again something you've touched on, Adrienne, which was in terms of share option schemes. Is that a process that is lengthy or costly?
You've got to get the right advice. It generally needs tax advice and legal advice, but the reward to the employee from being within a well-designed share scheme is itself a great return on the investment that is made by the employer. The cost will vary very much depending on the nature of the scheme and the type of the scheme, but in general you would want to design a scheme that gave you a return that was greater than the cost of putting it in.
Yeah, no, that's great. That's great. Thank you very much. I can't see any further questions, and I'm aware that we're getting close to the end of the half-hour slot that we have. So I would just like to say thank you very much to Adrienne and to Lee for their presentations, and also to Sam and to Caroline for helping organise this behind the scenes. I'd like to thank you as well for attending and for watching this webinar, and for taking your time out of the day for doing that. And I think with that, I'll just say if you do need any further information, then we will circulate this a set of slides around afterwards, and please keep safe, and if you need to get in touch, please do so. So thank you very much.